The price of oil crashed 9% on Monday to as low as $85 a barrel after President Trump called a 5-day ceasefire for negotiations. But looking at gas prices, you wouldn't know it. The average price of gas actually increased to $3.97 nationwide, 35% above where it was last month. So when will gas prices come back down? And is there a secret hiding in the stock market that can make you a lot of money while you wait for that $3 gas? I'm going to show you why experts say gas prices ride the elevator up but then the escalator down, why it takes so long for gas prices to come back down, and then 5 stocks to buy while it happens. We see here the impetus for why oil did fall as much as 11% there on Monday as President Trump put a hold on U.S. strikes against the Iran infrastructure that was set up for negotiations to try to get a way out of this. Now, will the war end? I don't know. Nobody knows quite yet. President Trump says his people are meeting with people in Iran. Iran is denying that there's actually any negotiation, so this is still very tenuous either way. The fact is here that Iran does not want to escalate this situation, and the U.S. has midterm elections coming up with, and affordability is already an issue, so those high gas prices aren't helping anybody. So everybody wants an end to this, obviously. We can see here in a chart of the price of oil was averaging about $65, $66 a barrel before the war started, jumped very quickly up to $75 a barrel on that first day there, February 28th, escalated along with those bombing strikes to as high as $115 a barrel. Gasoline prices jumped very quickly as well, almost to $4 a gallon from about $2.90 a gallon nationwide there. Came down a little bit to level off right around $100 a barrel in oil, and that's where it's traded at for most of this month. And then here we see this big drop just this yesterday down to about $89 per barrel of oil from $100 a barrel. But what's interesting here is if you look at the different months contracts on the CME, okay, so this is the Chicago Mercantile Exchange, they run the futures prices for oil. And what you got to understand is in the oil market, there's not just one price. There's one price for this front month futures. This is where most of the trading takes place, most of the hedging, your oil companies, the oil users like jets or like airlines, they come in here to the futures market. They buy contracts to buy oil for a certain price at a certain date, and that kind of locks in their price. So it's a good way to hedge if prices go up or down. But what this does for us is the different trading on this futures market tells us where the market actually expects oil to be over the next few months, over the months from this front contract of May, right? So right now, oil about $89 per barrel. Here in June, 86. July 83. So what this shows us is that the market expects oil to still be at about $80 per barrel all the way through August of this year. Okay, so not going to come down nearly as fast to that $65 a barrel where we were before Iran started. Now, there's a few reasons for that and a few other reasons why it could be a very long wait for those gas prices to come back down, and why the oil industry has that saying that gas prices take the elevator up. They go straight up, but then they take the escalator down. So that comes down in steps. It takes much longer for oil prices and gasoline to come back down to where it was before. Listen to what Henrietta Trey's, that she's the director of economic policy at the Vita Group, had to say about this.
Even if the war ended tomorrow, the backlog in the Strait of Hormuz is 150 tankers deep. And there are wells that have been bombed. There are wells that have been shut in because of the constrained supply of tankers and any place to even put the oil that they're able to extract. Countries across the Gulf have shut in their wells. So even if the Strait of Hormuz was reopened tomorrow, we estimate that it'll take at least 200 days to get the flow back to where it was before the bombing started on February 28th. And as they expand the military operations and Iran starts bombing in the region, including to their neighboring Arab nations, there are some ports and some outlets that are going to be closed for now 3 to 5 years. So getting prices back down to the range that we have become accustomed to is going to be a months, if not years long endeavor.
A lot of this has to do with the Strait of Hormuz, that choke point in the region here where 20% plus of the world's oil passes through this strait, and that oil tanker traffic has been frozen for weeks plus. But also that oil wells in the region have been bombed, wells have been shut in, which means they've been capped, and because there's just no place to put that oil. That tanker traffic has just been stopped cold, so there's nowhere to upload or nowhere to load all that oil. So a lot of oil companies in the region have just capped their wells and are just waiting. It takes a long time to uncap to get those wells back into production. Looking at satellite imagery here, this shows you just how bad this problem is. This is what the strait looked like yesterday. A massive traffic jam of 150, 100 plus ships deep on each side of that choke point. Here you see right on each side of the major choke point there in the strait, ships just bottlenecked up both of these. You cannot get those, these are massive, giant ships. You can't just put them back and forth across each other, okay? This choke point is very narrow at its most narrow. You don't just move this traffic in and out instantly. So getting that traffic back to normal is going to take months at a minimum. And then you get the biggest constraint here is just the supply chain has been completely broken here. Once you get that oil back on the ships, they have to go to refineries. Even a lot of that oil that just refines there in the area. Saudi Arabia, the biggest refiner there in the area, with about 3 million barrels of oil distillate they can push out per day. A lot of the U.S. oil, even though the U.S. is a net oil exporter, so we produce more oil than we need. We are an importer of gasoline. We just don't have that refining capacity to make all of our own gasoline. So we actually import upwards of 45 million barrels of gas a year. That is a big restriction here on the supply chain for the United States. Not only do we have to get the oil out of the United States, so export those barrels of oil out to be refined somewhere else, then we have to bring it back into the U.S. Once the gas actually gets back, it has to be distributed, put on trucks to those gas stations, all of which can take weeks and even months. So March and well into April, those gas stations, they're still going to be selling that gas based on the previous $100 per barrel. And they sure as hell aren't going to want to give up those healthy profits. So if you heard that news yesterday that oil prices came down and you're waiting to fill up the tank, hoping gas is going to get cheaper, you're going to be waiting a long time. But there is a huge opportunity in stocks. First, just in the general upside to all stocks, the entire stock market. Oil prices at $100 a barrel and even feared that they would go even higher, going to be a real pain point for the economy, maybe even a recession. So the S&P 500 here we see in this line was up more than a 1%. The NASDAQ, the tech-heavy NASDAQ, a little bit riskier stocks there in that index, also up 1%. Also, that fear and anxiety over just what happens next really brought a lot of the riskier stocks and investments down. So Bitcoin up more than 1% here. Even more important, though, is what didn't happen over the last month and how it can point to a little higher return in the future here as we see oil prices gradually come down, as we see gas come down very slowly. Notice here the State Street Energy Select Sector Spider, the XLE. Okay, that's an ETF that holds 22 of the largest companies in the energy space. So you've got your oil explorers, your refiners, your distribution there. All those stocks, the biggest stocks in the United States in that energy sector, only went up 8% over the last month. That was about 10% from when Iran started. You would expect this to come up a lot faster, right? If oil prices jumped so high, the people bringing that oil out of the ground, refining it, selling it to customers should have made a lot more money, right? We can see here in the tracker, energy up just 8% over the last month. And you can see the 22 stocks there in that. Some of them did very well. Okay, we have APA Corporation, pipelines there, VLO. So refining. The refiners did very well because obviously there is that bottleneck in refinery. There just is not enough, especially U.S. refinery capacity, to be able to turn that oil into gasoline. Valero up 20% there. Some of the oil explorers did very well also, 17% for Occidental Petroleum. That was Warren Buffett's favorite one. ConocoPhillips up 14%. So you did have some relative winners here in the energy space, but you notice none of these really did that well as you would expect when oil jumped oil jumped up to as high as $115 a barrel. Gasoline up 35%. You would expect them to do much better than this. And in fact, looking at that fund, all the 22 stocks in that XLE fund against the USO, this is the United States Oil Fund, so this tracks oil, right? With this light blue line is the USO that tracks the price of oil. The darker blue line here is the XLE, so those oil stocks. And you can see over the last 5 years, they have both tracked each other very closely, obviously, intuitively, because oil stocks should track oil, right? But you see how this is just broken down here over the year to date. The oil jumped to about 60%, 70% there at the peak, while those oil stocks only up about 33% for the year. And over the last month, it is even more. So over the last month, you see here that the price of oil jumping 40, 50% at its peak, and these oil stocks only up 8%. And what you got to understand, a lot of that gap was because Wall Street never expected the war to last that long and for those oil prices to come back down. Okay, again, this is an election year and affordability is a major issue. So Wall Street didn't expect this war to last even the 4 to 6 weeks that the government had been planning for. They expected it to come down very quickly. So that's why these oil stocks weren't bid up so much. But one thing I learned as a professional analyst for more than a decade on Wall Street there, folks, is you always follow the money. That giant gap between oil stocks and the price of oil, it doesn't change the fact that oil companies are going to be making a lot more money on that 1 month war and continue for as long as oil stays high, for at least another month or two. Here we have in data or in research from the NRDC, we have the oil company profit for every $3 of gasoline. And you can see here, for every $3 you spend on gasoline, those oil companies are getting more than $1 in profit. Okay, they typically pay about 39% of that price in production costs. Got another 1% transportation, refining costs about 10% of what you pay. 11% goes to taxes, but then those profits, 35% profit. So for every $1 rise in the gasoline over the last month, those oil companies are making a 35% windfall. All this means, as you wait for those gasoline prices to come down, put that money in some of these oil stocks. You will continue to make money on this, pay for those higher gasoline prices that are going to be high for at least another few months. Here we see Chevron Corporation, one of my favorite oil explorers. They've actually got a very, very well integrated supply chain. So they have the explorers, they have the refiners, they make money at every step in the process here, only up 11% over the last month. So lagging those oil prices, I believe that's going to continue higher as they continue to make money. And one of the clues that all of these high oil prices have not been fully baked into these oil stocks yet, we can go to the analysis tab here on Yahoo Finance. For Chevron, we can scroll down here to this EPS trend. Now, this is the trend in expected earnings per share, so expected profits for these oil companies for Chevron here over the last, current estimate, 7 days, 90 days. And we can see this has actually come down, okay? We can see here the current quarter from $1.81 down to $1.78 per share. Now, we do see here for the next quarter, for the June quarter, it has come up. So this partly reflects some of that extra profit from those higher oil prices. Earnings expected 90 days ago were expected at just $1.90 for that quarter. Now they're expected to come in at $2.18. We do see here for the current year. Okay, so analysts have upgraded their expectations a little bit. 90 days ago, analysts were only expecting Chevron to make about $7.55 in profit for the full year. Now it's $8.08. So we 808 divided by 7.55. So those estimates have come up 7%, but just the 1 month war with the oil prices staying high for at least another few months, that gasoline going to be high for even longer. Those profits are going to be a lot higher than 7% higher than what they were expected before the war. And there is a lot of value still locked up in this stock. And scrolling up here, we can see the revenue and earnings estimates for the year. Revenue expected up just 2.7%. Now, you show me a company that is is pulling this oil out of the ground. Oil prices up 30, 40, 50% just over the last month and expected to stay there. We saw that oil futures chart, the market expecting oil to stay up above $80 a barrel through August. And the market is still expecting, and these 13 analysts covering the stock are still only expecting Chevron to make 2.7% more sales, more revenue than they did last year. That is a that is a discrepancy. That is an opportunity here in the market to pick up these shares, because when they finally do report this full year, when they report these coming quarters of sales and earnings, they are going to surprise on the upside. Another one of my favorites here, Diamondback Energy, ticker FANG, one of the best oil producers here in the United States, has a lot of assets there in the Texas shale deposits. There, we can go here to analysis, see how those earnings have changed over the past month. So we can see that over the past month, their earnings expectations have increased here from $2.69 to $2.75 for the current quarter, from $2.73 to $2.93 for the next quarter. So earnings expectations going up quite a bit more than we saw with Chevron. So analysts do expect Diamondback Energy, to do much better on an earnings per share basis than we saw with Chevron here for the current year. We've got $11.48 per share earnings expected, divided by 11.46, but that's only an increase of less than 1%. Okay, so even though they're expected to do very much better for this quarter and next quarter, for the next 6 months, they're not expected to turn that into much for the current year. So I think there's, again, a real opportunity here in these shares that have not fully baked in these higher oil prices and the higher profits. We can see here for the full year, revenue estimates down 3.4%. So analysts actually expect revenue for Diamondback Energy to be down 3.5%. That is hard to believe how they're going to make 3.4% less in revenue than they did last year with oil prices so high. One of my favorite ways to play this, though, is closer to the customer. Those oil companies with retail distribution, with those gas stations. Here we have Phillips 66 up 14% over the last month. So doing a little better because they are one of the largest retail operations here in the United States, all those gas stations, but only up 14% when we know that they are making a lot more money on the price of gasoline. Here in the analysis tab, we scroll down here to this EPS trend. We can see also here in the history, we can see how well they've done over the past quarters. And you can see they almost always beat those expectations, beating expectations for earnings by almost 15% over the last quarter. So management doing a very good job of guiding those expectations, guiding those earnings expectations, and then beating what the market expects. But we can see here the market is just not loving the earnings on this stock. Just down from $2.35 down to $1.97. So over the last 90 days, expected to report $2.35 per share. Now they're expected to post just $1.97. So that is a very low bar for expectations. Makes it very easy for this company to beat those expectations when they do report earnings. We can scroll up here. We can see they're going to report earnings on April 29th. So I believe that's going to be a very good day for shares of PSX, for investors in this stock, because the market has just set such a low bar. Okay, such a low bar in these earnings expectations. We do see here for the next quarter and for the current year, earnings expectations went up a little bit more. So we can see here $12.20 expected to report for the full year, divided by that 1165 they were expected 90 days ago. That is 4.7% higher. Okay, so this company expected to report about 5% more earnings than they were expected to report just 3 months ago. But we can see it come up here, and again, revenue expected up just 1.18%. So less than 1.2% higher for revenue over this year from last year. I believe, again, folks, this is going to be a lot higher than even the analysts expect right now, just on that jump in oil prices and for how long oil prices and gasoline prices are going to stay higher. Check out the playlist of videos on the right for all the stocks I'm buying this year, your master list for stocks to buy. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.